Hello everybody, welcome to another episode of the Gold Forecaster Index, the holy grail to predicting the gold price. And a lot has happened since the last month. It's unbelievable how many events there are. So let's take a look at the gold price first. We are now at 1,614 per ounce. And last month it was somewhere here, 1,600. So it went up, and still flat. But I think that gold is going much higher, and I'll tell you why. Let's take a look at the new data point of the gold forecast index. So we're here, and the latest data point is going up slightly. So we're still in positive territory here. That means that gold price will slowly creep up. So it's still a very good time to buy if you haven't done so already. Let's take a look at some data here. The money supply. We are seeing here a huge increase in the money supply. So this was the first gear, second gear, third gear, and now we are going into fourth gear, so the turbo gear. So look at this. Since March, the money supply is increasing tremendously, and that will of course boost the gold price. It's very inflationary. We also had some trade balance numbers. The trade deficit went down. Look at this. So the trade balance is shrinking here, and that's also why the US dollar is going up. And yeah, that's a bit less good for the gold price, but I think the budget deficit will be going much higher here, so that will even that out. You can look at the budget deficit here. The budget deficit is still going higher, and it will go much higher because a lot has happened. And I'll talk about that in a moment. Let's take a look at the producer price index. It's gone down. Inflation has gone down a little bit. That's because we have a lot of bankruptcies, and that's decreasing the money supply. But the Federal Reserve is doing a lot to increase it again. So we have a tug of war between inflation and deflation, and it's not clear now who is winning, inflation or deflation. So we need more data points in the coming months. The capacity utilization rate was already declining, it's still in a declining trend. So the US is not doing great in the manufacturing sector here. Treasury yields have crashed down to zero. As you can see here, it crashed since this year, and yeah, the yields are now all at 0 to 1% here. Let's zoom in. Well, it has stabilized a bit since the intervention of the Federal Reserve and all of the stimulus packages. So now the yields have stabilized a bit, and we'll see what happens. Let's take a look at the balance sheet. Yeah, look at this. This is the Federal Reserve balance sheet. It was at 4 trillion, and now it's exploding to 5 to 6 trillion. It just keeps exploding. The ECB balance sheet is also exploding. That's the blue line. So yeah, Federal Reserve is buying treasuries, mortgage-backed securities, repo, It's just buying everything, also corporate bonds. You can see here that they are buying treasuries. So the blue line are treasuries. And soon they will also buy mortgage-backed securities. That's the red line here. Repo is spiking. It's gone down again because they have no collateral anymore to buy here, so that will go down. So I want to talk about the misery index also, which is the unemployment rate plus the inflation rate. And as you know, the economy is not doing well since March. So we have a huge spike in unemployment. I think we will go to 50% unemployment soon, 50% real unemployment. And if that happens, together with a high inflation rate because the Fed is printing money, then we will see a huge increase in the misery index. So this is going to go up. The PE ratios will go down with stocks crashing, and gold will be going higher because this misery index will go higher, and that correlates with a higher gold price. So that's what I'm envisioning here. And it will come very soon, let's say in a few months from now. So what has happened here? You can see this crash here in corporate bonds. So corporate bonds have crashed, and that has pulled down the stock market with it. We're now here. You can also see here BBB bond yields have shot higher. To even the AAA bonds shot higher. And the Fed came to the rescue here somewhere in March, March 20th, and they bought up all these corporate bonds back down, so the yields went down to calm the markets. You can also see that here, this was crashing like no tomorrow, and then they came to the rescue and it shot back up. So that means that GDP, real GDP, is not going to crash that much. It shot back up, but we'll need to see how this evolves. Because we're not done yet. Unemployment is going to rise still. We're not out of the woods yet. Here you can see what the junk bonds are doing. So the CCC bonds, the junk bonds, went higher in yields, which means they are crashing. The Fed came to the rescue, but as you can see here, end March to April, junk bonds are still crashing. So we need to see what the Federal Reserve is going to do here. Are they going to rescue the markets or let it go higher? So we need to monitor this. Let's take a look. This is the amount of public debt held by foreigners, and it has been crashing since March. So foreigners are selling US debt at a record pace. So they don't want to finance our debt anymore. This is also something that we need to watch. Let's see next week and the next months what this is going to do. Because if the foreigners don't want our debt anymore, then the Federal Reserve will need to print even more money to buy their own debt. Okay, next slide here. The LIBOR rate versus Fed funds rate. You can see here that they cut the rates multiple times. The Fed funds rate is now at 0%, so that's very good for gold. You see the yields they keep going down to 0. Something to watch. Look at this, the TED spread. It tells us if there is credit risk. There was a lot of credit risk here in 2008, and credit risk is now coming back. It's still rising, so we're not out of the woods yet. Okay, let's go over some of the posts. I'm starting from the beginning here. So what happened? So on 9 March, Chairman Powell started to increase the repo operations. It's just started at 100 billion to 200 billion. Very small. Very small. We're still in the billions here. And yeah, that was the first step. And then you go to the next post. So it was just a small blip upwards, increase in the money supply. But it will get much larger in the coming days here. So we are having a lot of corporate debt. Okay, so the next day, 10 March, the Fed did an emergency cut, a rate cut from 1% to 0% apparently, 15 March. The ECB also cut rates, wanted to cut rates by 10 basis points, but it didn't do so. The Bank of England cut rates by 50 basis points to 0.25%. Bank of Canada went from more than 1% to 0.75, and then it cut to 0.2%. Bank of New Zealand cut to 0.25%. So everyone is cutting rates now. And rate cuts are very good for gold. Okay, let's see what happened here. So that's the corporate debt that was imploding here. I talked about that. What we also saw is that the oil price has collapsed. So it went from 50 to 30 and now it's at $20. So you can see here that nobody can make money at $20. Even ExxonMobil cannot break even at $20. So they will probably do something to get oil back to at least $30, $40. Otherwise, these companies will all go bankrupt. And the funny thing is that oil production is still very high. So we have not deleveraged anything here. An interesting post here on platinum. So Amplats had an explosion at a platinum plant. So there has been a bit of disruption there. So platinum could be interesting. But yeah, not only an explosion happened, now all the mines are also closed. They have force majeures due to the virus. And then something happened here. At 12 March, they started to fire bazookas. So we started with billions and now they increased the repo operations to trillions. You can see that here It was 20 billion and now it became 500 billion. So we are in the trillions now of repo operations. What they also did is increase the size of the QE to trillions, buying treasuries and mortgage-backed securities, cut rates to 0. Then it became 1 trillion here. They had a stimulus plan of 1 trillion. Eventually it went to 2 trillion, actually 6 trillion. So it went up and up. They also made sure that the repo collateral included equity securities and corporate debt. That's very important. So the Fed can now buy stocks and corporate bonds. The ECB was also doing some QEs, 750 billion bazooka. You can read that here. The Fed opens swap lines with central banks. Bank of Canada, England, Japan, ECB, Swiss, also Brazil, Denmark, Korea, almost everyone. So they are flooding the world with dollars. They had a stimulus package to 4 trillion, and then they eventually said that QE should be infinity. So they are just printing infinite money. And that's when gold started to skyrocket from 1500 to now 1600, probably going to 1700, 1800 very soon. So that's the deal here, 6 trillion. So we started with 20 billion and we are now at 6 trillion, 10 trillion, unbelievable. So this is the deal about the 2 trillion bill. So they're sending checks to everyone. Everyone will get a $1,200 check, and corporations will also get some stimulus. The last update here is that the G20 will also do 5 trillion stimulus. So we're talking about trillions now. So that will boost the gold price much higher. Okay, where were we here? Germany also pledges unlimited cash, and then the bond yields spiked. So once this happened, when QE was announced, then we saw something else happen. We saw that gold and silver were smashed down. It's only the paper price that was going down because the premiums were skyrocketing. So this was the first day when that happened. Silver was smashed down to 12, and the premiums were skyrocketing here to 70, 80%, and it went as high as 100%. You can see here that they couldn't deliver any physical silver and gold at different brokers. And I've made a chart here with the debt to GDP, government debt and household debt. And if you add them together, then you can see that these countries will be the most in problems because they have very high debt loads. Japan, Greece, Canada, United States, Italy. And these countries will be in good shape, like Russia and Saudi Arabia. We got some news also on the power consumption of China. It was crashing, of course. Power consumption growth went negative, and GDP is also going to crash here. Another chart here, power consumption growth going down. You see here a very big drop here in China power consumption. So China is also not doing well. Oil was not doing well. And this is a very nice chart, very nice. So this is actually a supply-demand curve. So this is supply. The baseline is the yellow one, that's no increase in production. So this is the normal supply line. And Saudi Arabia and Russia are increasing production. So this supply line goes to the right, more to the right. The demand line, that's this here. That's the demand line. And you can see that if there's no corona impact, then we are here. This is the normal price of oil at 25. And we are seeing that demand could go down 10 million barrels per day. You can see that here. 10 million barrels per day in March, because there's a lot of decreasing demand from the OECD countries. And in April, we can even see 20 million barrels per day decline. So if we go back to the other chart, you would go from 100 million barrels per day to here 90, and then even here 80 million barrels per day. So you can quickly see that the oil price is going to go to zero here, zero. So if nothing happens, if we go to the equilibrium price, then this would go down, down, down into zero in a few months from now. If there is a demand reduction, like given on this chart here. Now, what is happening here globally and geopolitically? China is now buying up oil to prop up its oil reserves. So demand is going to increase a little bit. So that has increased the oil price. And a second update is that President Trump is now meeting with Saudi Arabia and Russia to decrease production. So that would push the supply curve a bit to the left again. So that would push oil prices higher. We'll see what happens if they can bring oil back higher, because otherwise shale will be bankrupt in a few months from now. Bond market is selling off. That's correct. Commercial paper rates were rising here. Yeah, that's also not good. So these are signs that banks are not lending to each other. This is a very interesting chart. I want to talk about it a bit. So in 2008, we saw the same thing as what's happening now. The VIX went up very high, and that caused margin call selling. A few of these hedge funds were blowing up, so they had to sell even gold and gold mining stocks. And what happened is that gold went down together with the stock market. But once the VIX selling succeeded because of government intervention, then the VIX went back down, and then gold went back up. So we are seeing the same thing here. Somewhere in March, we had a top in VIX, and now it is going back down a little bit. So it could be that the gold selling is now over, and we will go back higher and go to new highs, to 2000 in a few years from now. So that's something to watch here. Very interesting. Silver premiums are rising, that's correct. Also very interesting to see is that the US Mint Eagle sales have exploded now. So it went down for several years and suddenly we have seen a large sales here, both in silver and gold. Also in the SLV Trust, we see that the SLV Trust stock levels are going higher, even with declining silver prices. So I expect that the same will happen here. The trust goes up, but initially it goes down, but then it will eventually go back up to the same level. So this will go back up to the same level here. You can also see that the commercial shorts have covered here half of the shorts, and this can go even higher. And then they will have covered all their shorts, and then silver is going to bottom out. Something to keep in mind. Already talked about the premiums, they went up. Premiums on junk silver went even to 80, 90%, and they are still at 80% now. So where are we in the permanent portfolio? So you need to always keep in mind in which quadrant we are. We are certainly not in a growth phase, so these two are bad things to invest in. So you should be in these quadrants. Cash is the most safe in this environment. So being in cash is not that bad. And then you need to choose, will you go in gold or in bonds? Are we in inflation or in deflation? I'm not sure which side that we are now, but I tend to go to the left side here. Also, something happened in the rhodium market. We had record highs here in at 11,000 per ounce. Then it crashed back to 2,000. That's huge. That's a huge plunge. So if you knew that this would happen, if you looked at this, then you could buy at 2,000. And now it's already back to 8,000, I think. So you could make a lot of money buying rhodium. This is a chart about the stock market, which is going down, and the Federal Reserve buying assets. And you can see that the correlation is not correlated anymore. So they're trying to prop up the market, but it's not working anymore. But I think that gold will eventually catch up with all this money printing. This is also a nice chart here. You can see here how much base money there is in the world. It's around 20 trillion here. So when the Fed prints 10 trillion, which it is really doing now, then base money could be inflated by 50%. So I expect that gold also goes up 20 to 30%. So we should go above 2000 soon. Another news, very important also to know if you want to invest in gold miners, they have been shutting down all over the world. So this is my summary here. Most of the production is around 30% to 40% that has been shut down now, and most of them are about a month time frame, and they could of course be extended for many more months. We do not know how long that this virus will continue. But this is something to take into account when you invest in the gold miners. For the silver miners, you can see that today the world production that is offline for silver is around 50% for these countries. So 50% is offline of world production. But yesterday, Mexico also announced that they would close all the mines for 1 month. So that means that 23% of global silver is also going to shut down. That means we have 75% that is shut down now, and that should be very good for the silver price. So I think silver should be going higher. Some charts on the silver supply and demand. You can see that demand is going up, but yeah, these are old numbers. I expect this to crash this year. Supply is going down. It's also going to crash this year. We're not sure yet how the demand and supply picture is. Also on the COMEX, something happened. There's a lot happening in the last month. Um, this chart says it all. Apparently, there's an explosion in the registered gold at COMEX, and possibly that's because a lot of people are now standing for delivery of their physical gold from the COMEX because they can't get it anywhere else. And we see a huge increase in this registered gold here. So the COMEX needs to supply all this physical gold. And currently you can only get gold at above $2,000 in some places, while the gold price is now at $1,600. So there's a huge premium on the gold price now, and I expect that gold will be going much higher. We just had initial jobless claim numbers. It is unbelievable. Look at the history. And suddenly we have a spike of 6.6 million jobless people in the past 2 weeks. That's unbelievable. So the unemployment rate has spiked from 3% to now over 10%, going much higher to 30% and then 40%. So this is not good. Eventually, 47 million people in the US will have no job here. So we are going into very bad times ahead. I hope you have prepared for this. And yeah, I'll see you in the next video.